Hello friends, my name is Bharoz and welcome to the channel where I share with you tips, tricks that I read, learn and apply in order to become my best version. Now in this video, I will talk about why I am still investing despite the stock market dip, and I'm buying the dip and why you should buy too. Now just to give you a background, that my total portfolio of stock investments is red. That is, it is in negative right now given the recent dip that the stock market has seen. However, I'm still buying and I continue to recommend you as to buy the dip that is there. And I will explain in this video why I'm recommending to buy and why I'm still buying. So in essence, I will talk about not just why you should buy this particular dip that has happened, but for that matter, buy anytime there is a stock market dip and why we should be buying. Now let me set one thing very clear, which is why we should invest in the dip has a very clear answer, which is that the stocks are available at a bargain price, the market is at its lowest, and hence it's a buying opportunity. This one is very easy. However, the challenge is that we still remain cautious and we are in fear due to various reasons. And so instead of talking about why you should buy the dip, I will start by talking about what are the reasons why we don't buy in the dip, despite seeing the buying opportunity, despite seeing good deals, despite us buying when the market was going up and it was expensive, we were still buying stocks. And now suddenly the market is down and it's cheap and everything has changed and now we don't want to buy anymore. So what are the reasons which restricts us from buying in the dip? I will talk about them first, because if we are able to address what are the things which are holding us from buying the dip, then it would be very easy to go to the point and make sense of the point that we should go and buy the dip. So in a nutshell, we will tackle this question in a reverse manner, which is what makes us cautious and fearful of buying into the dip and how to solve for it. Essentially, there are three reasons why we are cautious from buying the dip or we are fearful. One is the market may go down more. So why buy now? I rather wait and let the market crash even further and then go ahead and purchase. Second question that comes to the mind is, will the market ever recover? So what if I start buying and the market doesn't recover at all? And the third question is, even if the market is down and everything is cheap, I don't know what to buy. So what if I buy a risky stock and it goes down further while the rest of the market starts to go up? What will happen then? So I will address these three questions one by one and peel it and try to understand how we can solve for the bias that is being created through these three questions which pop in our head and restricts us from a buying opportunity in the market. Now let's start by talking about what if the market goes down further. Let me put it very straight. It is a godly trait to be able to time the market. No one has ever been able to time the market, and all of those who have claimed to time the market have timed it either by a fluke once or twice or have been burned badly eventually by continuously trying to time the market. So it must have been a fluke at best, but no one can technically on ongoing basis time the market. And every time I've done it, there have been times when there was a fluke and I felt good about it, and as I continued on the route, I've been burnt badly. And overall, in let's say 10 to 12 years of my investment life, I've lost more money by trying to time the market versus just trying to stay in the market, which is more time in the market. Hence, I talk about that at any given day, the best strategy is daily cost averaging, and on which I've made a separate video, which you can check out in the link above. Now, since it's very high in Jan 22, the S&P 500 is down approximately 25%. Looking at the history, we can tell that since 1946, the market has seen a dip of around 20 to 40% at least 9 times, which means a dip approximately every 8 to 9 years. So while it is impossible to say whether this is the final dip or the market will crash further, what we can tell from certainty is that this is a rare occurrence. This is an occurrence that happens every 8 to 9 years where the market is dropping more than 20%. And every time the market has come back. So the main assumption or trust that you need to hold here is the trust in the American economy, which means that on a whole and in long-term basis, the American economy will continue to grow around 8% year on year as it has done in the past. There might be some dips, there might be some ups and downs, there might be rough rides, but on the long-term basis, the growth will happen and there will be a growth of approximately, as I said, 8% as we've seen in the history for past around 80 to 100 years. So as long as we have the trust and the assumption that this is not the end of the American economy and the American economy will eventually recover, we can move to address the second point of concern that limits us from buying the dip, which is that the market will take longer to recover, which is it will take more number of years or time for it to recover. So in order to address this concern, what I will do is I will reframe the upside for you. So for instance, despite the seemingly obvious upside to buy the dip during the COVID crisis, or let's say the financial recession of 2007, many investors were afraid to do so. And unfortunately, the problem seemed to be the way they thought about the issue. So for instance, let's take an example of the COVID crisis, whereby on March 2022, the market dipped around 33% from its highest ever. How long do you think that the market would have taken from its 33% loss? What would you have said, whether it will take a month, a year, 2 years, 5 years, or 10 years? Similarly, same question for the financial crisis of 2007, where in October 2007, the market dipped around 57% from its highest point. At that point in time, what would you have concluded as to how long will it take for the market to recover and go back to its highest level? Because based on your answer, we can back out the annual expected market returns for the market going forward since the dip. That is, basis whatever expectation you have in terms of the recovery time, what is the return that you should expect on annual basis, starting from the dip. So let's take COVID crisis as an example to elaborate my point. Mathematically speaking, a 33% dip in the market would require a 50% gain from that dip in order to be back to the highest point. So once I know how much time you expect the market to take in order to recover and go back to the highest point, I will turn that 50% upside into an annualized number. As I just explained, if you expected the market to come back to its highest level in 1 year, that would have been a return of around 50% on your investment. So if you bought the dip, you would have gained 50% on that investment, which is for every $100, you would have made $150 after 1 year. If you expected the market to take 2 years, that would have been 22% return every year on your investment. 3 years would have meant 14%. 4 years would have meant 11%. 5 years means 8%, and 6 years mean around 7% return annually. And these returns that I'm talking about are without any dividend returns. So for instance, if you are buying an index fund such as SPY, which gives somewhere around 1 to 1.2% dividend return, that means you can add that 1% on top. So for instance, if you expected the market to recover in around 6 years time, that would have meant 7% return on your investment plus a 1% dividend return. So around 8% in total return, which again is very good, which means you are almost doubling your money every 9 to 10 years. And it's the same kind of return that the market has seen historically. For me, at the time of COVID crisis, I expected the market to return in around 2 years time, which means for every dollar that I was investing in the market, I would have expected a 22% return, which is phenomenal. So while it seems a doomsday scenario and you're just scared of the market, reframe your thinking in terms of, okay, let's say how many years would it take for it to recover? For instance, if your number was 3 years, it's still a 14% return, which is still very, very healthy. More importantly, even those who expected the market to return, let's say in 5 years' time, would have still made 8% annualized return, which is similar to the long-term average return that have been delivered by the US stock market. Plus, if you add the dividend income on it, which is, let's say if you went for an SPY index stock, which replicates the S&P index, that would have been another 1% dividend earnings on top of your 8% return. So let's say a 9% return year on year if the recovery time was 5 years. That is why buying in the crisis was such a no-brainer. Even in the scenario where the market took half a decade to recover, you would have still earned 8% return on your investment while you waited. I did same math for the financial crisis as well, where the market dipped more than 55% since its highest level. Now let's take the financial crisis as an example, where the market dipped more than 55% since its highest level. And it took slightly less than 6 years for the market to recover from that dip. So if you had invested in the dip and it took 6 years for the market to recover, that means you would have earned 15% annualized return on that investment, which is again massive returns. So taking the examples of the 2 dips that we've seen in past 2 decades, and if we take a horizon of around 5 years to 6 years, still we end up making significant returns if we had invested in the dip. Now this logic can be used in any future market crisis as well, because if you had bought anytime the market went down by 30%, your future analyzed returns will be quite good. And here's the chart which shares the analyzed return every time you had a buying opportunity when the market dipped by more than 30% between 1920 to 2022. The returns shown are from when the market was down 30% or more until their next all-time high. The chart implies that there is a less than 10% chance that you would have experienced 0 to 5% annualized return. including dividends and adjusting for inflation. When buying when the market was down at least 30%. This is such a low chance. And even at low chance, you still make some returns. In fact, more than half the time, your annualized return during the recovery would have exceeded 10% return per year. Now let's look at the numbers given the recent dip. The market is down 25%. So think about a time frame that you think it will take for the market to recover and reach back to its highest level. If it's 1 year, it's a 31% return that you'll earn. If it's 2 years, that's a 15% annualized return that you'll make. If it's 3 years, it's a 9% annualized return that you'll make. If it's 4 years, it's a 7% annualized return. And if it's a 5-year period, it's still a good 6% annualized return that you will make, plus add on top 1% of dividend income, which will make it around 7%, which means that you would be doubling your money in 10 years' time. So again, by reframing the upside, you can gauge and create a range in your mind in terms of what kind of returns you should expect. And breaking the problem that way makes it less fearful when you have to invest during the dip. Now let's say with all the arguments that I've placed, you are convinced that you would want to buy this dip. The question comes is what to buy. I won't go and answer this question in detail in this video because I have created a separate video to answer this particular question, for which I'll leave the link of the video here above. Now before I end this video, let me address one last thought or question that may come in your mind, which is how to go about investing the cash that you are carrying during the dip. Now, as we know, it is impossible to tell whether this is the end of the dip or there is more. Hence, it is advisable not to throw all your cash in one go, rather break it into chunks. So I would just go and buy some in this dip and then wait for another 2 to 3 weeks and see how the market is trending. And basis that, I decide to invest more and more. If the market starts to rise, then I would be more cautious and invest in small chunks. But if the market starts to dip further, then I would invest in bigger chunks in order to get the benefit of the lower and the cheaper market that is available. This way, in some way, you would be averaging out your investment in and around the dip. As some days you will be buying slightly higher and at some days you will be buying slightly lower. And hence you will kind of try to average out around the dip that you have today. Thank you for watching this video. Hopefully this will help you now get more confidence or at least some reframing of how you think about investing during the dip. Thank you.